The following script was written, verified, and approved by compliance professionals at financial regulation courses. The S&P 500 is a float-adjusted market capitalization weighted index tracking 500 leading publicly traded U.S. companies. Serving as the primary benchmark for large-cap performance, it represents 80% of total U.S. market capitalization. This benchmark is a critical concept for the Series 65 exam. Focusing on index methodology and benchmark relative performance evaluation is essential for navigating equity market structure questions. The S&P 500 utilizes a float-adjusted market capitalization methodology. This means a constituent's weight is determined by the market value of shares available for public trading. This excludes closely held insider shares. To calculate the index level, we multiply the share price by the public float for each company. The sum of these values is then divided by a proprietary divisor. This divisor ensures that the index level reflects true price changes rather than corporate actions. It protects the index from artificial movements caused by composition shifts. Notably, the 5 largest constituents often exert disproportionate influence on the total index weight. This concentration factor is something fiduciary advisors must monitor when assessing broad market trends or potential portfolio divergence from the median constituent company's experience. Membership is not automatic. It is determined by an index committee based on strict eligibility criteria. Quantitatively, companies must meet minimum unadjusted market capitalization thresholds. Furthermore, specific liquidity requirements, a minimum public float of 50%, and positive cumulative earnings over the most recent 4 quarters are mandatory. Earnings must be determined by GAAP reporting. Qualitatively, the company must be U.S. domiciled and listed on an eligible domestic exchange. While real estate investment trusts are eligible, business development companies and limited partnerships are excluded from consideration for the index. The committee announces changes with several days' notice, often producing measurable price movements as passive managers adjust portfolios to maintain accurate index exposure. Under the Investment Advisors Act of 1940, advisors must understand how client portfolios compare to the S&P 500 as the standard large-cap equity benchmark. Unlike the price-weighted Dow Jones Industrial Average, where higher-priced stocks carry more weight regardless of size, the S&P 500 reflects true economic significance. It also contrasts with the Russell 2000, which benchmarks small capitalization performance. Fiduciaries use the S&P 500 to evaluate alpha and risk-adjusted returns. These calculations use the S&P 500 as the market portfolio proxy. An advisor must justify active strategy fees by demonstrating performance relative to this benchmark. For income-oriented clients, the dividend aristocrats, a subset with at least 25 consecutive years of dividend growth, provide a quality filter for durability. To conclude, the S&P 500 is the most comprehensive practical proxy for the broad U.S. equity market. Retain the core facts for your examination. It is float-adjusted, market cap-weighted, and comprised of 11 distinct GICS sectors, reflecting the structural evolution of the U.S. economy. Understanding its construction, from the role of the index committee to its fiduciary application, is essential for any professional navigating the regulatory landscape. Mastering these concepts will ensure you are well prepared for your Series 65 licensing exam. Thank you for choosing financial regulation courses.